Ever thought about how banks actually make money? No, I'm not talking about the boring way by charging you ridiculous overdraft fees. I'm talking real money, like where does it come from? Contrary to popular belief, banks don't store your cash in a vault like some old-school treasure. They actually have a magic trick up their sleeves, one that'd make the best illusionist jealous too. Banks create money out of thin air. No printing presses, no gold reserves, just some financial wizardry. So, how is it done? Let's break down the greatest financial illusion of all time. The fractional reserve trick. All right, here's the deal. Whenever you deposit money, it doesn't sit there waiting to be used by you. Nope, the bank actually takes most of it out and loans it to someone else. For example, if you deposited $1,000, the bank is required to keep only a fraction of it, around 10% as reserves. So what happens to the other $900? A random person, let's call him Bob, comes along and asks for a loan. The bank takes your money, gives him $900, keeping the 10% for the reserves. But when you check your bank account, it still shows $1,000. How's that possible? To add to all that, Bob will also spend that amount at a local store or somewhere. Let's say he buys something worth $900 and then the store deposits that money back into the bank. And guess what? The bank keeps the 10% and loans out the rest again, this time to Peter. The cycle keeps on repeating, multiplying money every time, and that's what you call the fractional reserve banking system. That's how these institutions turn small deposits into massive amounts of money. Spooked yet? Hold on, it gets crazier. Debt equals money? Did you know that almost all money in the economy is actually debt? Yep, it's true. Whenever a bank loans money, it doesn't take it from an already existing pile of cash. It simply creates new money by typing commands into a computer. Because banks don't need to have the money they lend, they can just make it up. Surely there's an explanation, right? There is. Let's take this example. You get a mortgage for $300,000, but the bank doesn't pull that from some secret stash. They just credit your account based on your promise to pay it back. And this happens every time a loan is made, from credit cards to business loans. Everything. Money isn't backed by gold, silver, or cash. It's just backed by your presumed honesty. Oh, and when the loans are repaid, the money that was initially created just disappears. Yep, if you were to pay back your loan, the money supply actually shrinks. This is why economies tend to slow down when people stop borrowing. And for a healthy economy, a continuous cycle of borrowing and repayment is crucial. No debt, no money. Businesses struggle, jobs disappear. Central banks slash interest rates in order to encourage more lending. It's basically an endless loop, and it has been running for centuries. How digital money multiplies now. The next question is, how's all the money created in the digital world? Well, allow me to welcome you to the age where money is more illusion than ever before. We're hyper-connected and app-infested, so banks don't even bother with physical cash anymore. The days of printing those crisp dollar bills are ancient history. Banks simply hit a few keys. Poof, new money appears out of thin air. In fact, over 90% of all money isn't cash, gold, or basically anything tangible. It's only numbers on a screen and exists only in digital form. So, the next time you swipe your credit card, think about how you're not actually spending the money stacked up in a vault, you're borrowing digital dollars. Magic, right? Banks have found the ultimate hack. Why even print cash for every loan issued when you can just update the balance in an account? Money has now become a glorified Excel spreadsheet, except the numbers dictate the entire global economy. But here's where it truly gets wild. As money is just digital, it multiplies quicker than rabbits. It keeps on stacking up as banks are loaning more than ever before. There are no real-world limitations either, just endless zeros and ones typed by financial institutions like puppet masters pulling invisible strings. So, yeah, if you just picked up your phone to check your bank balance, remember? You're staring at a digital mirage, a financial hologram created by the banking system's greatest trick of all time. The invisible expansion of money is a lot like a balloon. It inflates with loans given out, increasing the total supply of money in the system. But this expansion isn't limited only to banks. Even governments, corporations, and other financial institutions get to play a role in this money multiplication. Bonds, financial derivatives, and other credit instruments are all working on the same model, creating money out of thin air. But just like a balloon, if you put too much air, or in this case, money, it could pop. So to control the rate of expansion, the central banks step in. The role of central banks. So far, we looked at all that a regular bank can do. Now imagine the power that central banks have in this day and age. Institutions like the Federal Reserve in the US or the Central European Bank control the entire money supply at a large scale. They're the ones who set interest rates, print money, and also decide how much banks need to keep in reserves. Central banks are the lawmakers of this world. They get to flood the market with money during economic downturns, lowering interest rates to make borrowing easier and more appealing, while tightening the leash during booms to prevent inflation. Ultimately, though, central banks also consist of humans, and humans are prone to mistakes. So, the scary part in all this is, if central banks miscalculate, we could end up with economic chaos. This could mean a recession or runaway inflation. Either extremes are basically fatal to an economy. Another fear people usually have is about quantitative easing. Don't worry, it's much simpler than it sounds. It's a fancy term for printing money out of thin air to stimulate the economy, and it's been used by central banks for decades. The problem is, the debt-fueled system resembles a complex Ponzi scheme at times, and if it hits a wall, then what? The takeaway point is, banks do more than just handle your money. They manufacture, control, and shape the economy. Every single dollar you have exists because someone else took out a loan. Every swipe of your card creates money that didn't exist a second ago. Every mortgage, every student loan, car loan, more money conjured out of thin air. This creation keeps the economy running, also keeping us in a loop resembling a hamster on a wheel. We keep borrowing, banks keep profiting, and when we repay, they benefit some more. Oh, and when things go south, history suggests that banks don't really take the fall. We do. So yeah, the next time you hear about banks lending money, remember, they're just dressing it up. What they're doing is creating money with a few clicks instead, and the only thing keeping this facade from failing is another intangible, trust. And there you have it, the story behind the money illusion the banks use. Where do you stand on all of this? Do you think it's an impressive trick or rather the biggest con of all time?